everyone, and welcome to the Real Estate Rundown. I'm Elizabeth Walker, and we have Miranda Dunsmuir here today. How's it going, Miranda?
It's pretty good. I don't know if anybody can relate to this, but my AC has broken today and it's like 30 degrees out. So we're doing the slick back hair. We're melting, but
The hot one. It
we're
is
still doing mortgages. That doesn't stop.
awesome. Well, tell me a little bit about yourself, and then we'll dive into some questions.
So I think a great starting point is like about our relationship. I am a
sure.
husband. Yeah, we kind of like married into the family. We've known each other since you were like, I used to babysit you when you were like 6, 7. So this is kind of fun now, right? Dynamics changed. But yeah, as you said, my name's Miranda. I'm a mortgage agent with Vine Group. I've been in the industry for about 2.5 years now. And I know what everyone's thinking when I say that. That is like the worst time to start in this kind of market. But I've been really fortunate. I've kind of assisted on a book of business. It's doing like close to 200 million a year. So I've been through what we like to refer to as mortgage boot camp. Sure, if you guys have seen me on Instagram, my mentor is Johnson Andrews of the Vine Group. So we work a lot on all of our stuff together. But yeah, everything with Alyssa, we kind of do together as well.
Awesome. You're like a little dream team.
Yeah, duo.
Okay, so I'm just going to be asking you a few questions today, questions that I get quite often, and just to explain the whole mortgage process to people that might not know how it goes. So, first question, can you briefly explain what a mortgage agent does and how you can assist your clients?
Yeah, that's a great question. So I know, like Alyssa, you work a lot with first-time home buyers. So this tends to be like the starting point for like most of our clients together. Most people don't know the difference between why wouldn't like I just go into my home branch and secure a mortgage versus working with a mortgage agent.
Yeah.
Or you might already have some background knowledge in it because the use of mortgage agents has increased over the years. But essentially, you have to think of us like it's us versus the banks. We work with over 60 different lenders. And like my fiduciary duty is to your client. We want to secure the best terms, the best rates, and educate your clients along the way. I'd say the most common thing I get asked is, do we pay you? That answer is no. This is why I like to say it's us versus the banks. If I'm not getting you the best rate, if I'm not picking up your calls, if I'm not giving you that great service, why would you use a mortgage agent as opposed to the bank? So that's kind of the goal with everything that we do, is treat your clients very well and get them options when sometimes banks can't give you options, or maybe you can't get approved by a traditional bank. That's also where we come in. We can come up with some creative solutions and also tailor our solutions to each individual client.
Awesome. So it's not a one size fits all type of thing.
It's definitely not a one size fits all. I think especially in this last, like the environment that we've been in for the last couple of years.
Yeah. It's been
Well, I think that's why we've been getting a lot of calls. Like some people have experienced the opposite of that, especially with not as many people purchasing. I think it's a great time to be using a mortgage agent because we can, like, I always like to say to people, not every lender does everything perfectly, but one lender we work with will probably do everything perfectly for you. That's our job to find it. So going back to that, the bank pays us, not you. That's what I get from most of your clients. Who pays you at the end of the day? It comes from the lender, and it's all relatively the same. So there is no bias or allegiance to a specific lender.
I don't even know if I knew that you got paid from the bank.
Well, we're going to learn together today, too. I'm sure you're going to teach me some things, too.
I'll learn lots. Okay. Well, can you walk me through a typical mortgage application process? Like if I was a first-time home buyer?
Yeah. So generally, say I'm like working with referral partners, I'll get an email intro, but regardless of how the client finds me, I like to do what I like to call like a know your client call or an introduction call. They tend to be like 15, maybe 20 minutes if like I'm chatty, they're chatty. But essentially it's going to go over the basic information that I need to know to hand your client an application. So those would be things like, what did they do for a living? Have they had any issues with credit in the past? Going over down payment structures and kind of getting a basic idea of what the goal of the client is, whether that's a renewal, whether it's a refinance, or whether it's looking to get into the housing market for the first time. really understanding the client's goals is basically the starting point. After getting a client an application, it's my job to kind of go through that application and find what they can qualify for, what their different options are. And kind of unique to like what me and Johnson would do with each client is we like to run like a full analysis. So we always like to say, if you ever want any clients to move forward with confidence, they have to be educated. So often in our business, it's like, here's your rate, here's your product, go ahead. Yeah. For us, it's reviewing your credit score and your credit bureau and what that looks like. It's going through the different ways that each lender is going to be looking at your application. It's going to be going over whatever other obstacles might be in the way, or maybe it's smooth sailing. The whole goal is to empower people to make good decisions. From there, it's kind of going back and forth with the lender, all that crap nobody really likes to hear about, more like paperwork, compliance, all that kind of stuff. But essentially, once we've come up with a solution that a client's comfortable with, whether it's renewing, refinancing, or a new purchase, we kind of move forward on the journey together. Whether that's also like working with somebody like you, we've been through this process, sending me the APS and all of those things, right? Yep. But at the end of the day, it's to secure the best rates and terms for each client and get all the paperwork and documentation done for that. Awesome. But with us, it's following up with the client even afterwards. Like, did your first mortgage payment come out okay? Keeping them notified if there's any changes in the market that we can maybe move them lenders. The name of the game is, if we can save you and your clients money, we also end up making money at the end of the day. So it's kind of a 25 to 30 year relationship.
So what factors do lenders consider when approving someone's application?
First thing that a lender is going to look at is your credit score. Okay. It's a really easy way for them to see if they want to proceed with your application or not. Okay. Here in Canada, we really operate on kind of a pass-fail basis. If it's 650 and above, you're pretty much green to go anywhere. So then you move on to the next stage. In that, the lenders look at what's called your debt to income ratios. And that's exactly as it sounds. People think it might be some riddle, but it's not. It's what's the income on file versus what's the debt on file.
Okay.
So whenever you're thinking about purchasing a property, there's two main ratios that you're going to want to keep in mind. One is your GDS, or your gross debt servicing ratio. The second is your TDS, which is your total debt servicing ratio. I know that probably sounds like a bunch of gibberish, but the easiest way to remember this when you're thinking about income versus debts is think about the acronym PITCH, like throwing a ball. Mm-hmm. So they're going to look at what the potential principal and interest payments would be, what the taxes would be, what condo fees would be, and what the cost of heating would be. Huh. Heating is always $100. Doesn't matter if it's a 1,000 square foot apartment or if it's a 10,000 square foot house, always $100, which kind of highlights how archaic the banking system can be at times.
Yeah.
Your GDS would be your income versus pitch. TDS would be the total debt. So anything that would be like car payments, alimony, child support, and the cost of the property versus your income. So that will tell us whether you qualify with an A lender, whether we have to go B, or some cases it could be a private. But those would be the two main things that lenders are going to be looking at.
So what if you have under 650 credit score? How does that affect you being able to get a loan?
So it's definitely going to affect your rate. Once you reach a certain credit score, we're going to have to go into the private space, so there might not be options available for you. But I would say like over 80% of the population is actually 650 and above. I think a lot of people don't know that. Mm-hmm. Yeah, so I'd say like the base of my clientele is in that range, but that would be moving into the B lending space when you're allowed to have more debts versus your income on file. Okay. But as far as your credit score goes, this is actually probably one of the things that clients find most interesting, is because I think a lot of the stuff that we learn, people are like relating us to the US, when your actual credit score does impact the rate that you're going to get. And like off the top of my head, I can only think of one lender that your rate will be impacted by the mortgage size and your actual credit score, but there's a cap on that. What lenders are actually going to look for is your repayment history. Sorry, there's 4 things that go into like the credit score. Okay. Your repayment history, mm-hmm. the types of debt that you can hold. So that would be installment debt or revolving debt. So revolving debt would be things like credit cards, lines of credit. Installment debt would be things like your mortgage or a car payment. So if
Gotcha.
you've proven that you can make those payments on time and you can handle those different types of loans, that will increase your credit score. So a lot of people think that getting a mortgage might like impact their score. It will actually help your score because that is a new type of debt that you're taking on that you show you can manage. The
Ah,
next thing that lenders are going to look at is your utilization. And I would say that this is my favorite one to talk to people about because it is the most common one where people can kind of manipulate in order to increase their score.
mhm.
Utilization is of your allotted credit. For simple numbers, we'll say you have a credit limit of $500, which is not a lot. So again, using simple math,
Okay.
say you have a limit of $500. They want you to only be using 30% of that $500. If you're using more than that, it shows that you are heavily reliant on credit. So utilization is actually the easiest thing that you can manipulate. So say if you have a credit limit of $1,000 and you're constantly spending $1,000, it's not a great look for the lenders in terms of how reliant you are on that and how good you are at managing your money. So one quick tip, just for anybody that's listening, is obviously try to keep that utilization under 30%. But if you can't, as opposed to waiting for your credit card statement to come in and then paying it, which is what so many people do, look at the date that your credit statement is issued. Oftentimes it can be, say, on the 15th of the month. Instead of waiting for that statement on the 15th and then paying it afterwards, pay it before that. Because there's actually only one day of the month in which the credit bureau is going to be looking at this. So it would be, say, a snapshot on the 15th of the month. How much of your utilization have you used? And that's what reports to the agencies. So if, say, on the 12th or the 13th, you pay down your credit cards, it's going to look like you're using less of the utilization and the limit. So that's always one that I use with my clients that are looking to increase their score quickly. I've seen scores go up like 40 points in a matter of like a month or two just by correcting that utilization. But
Damn.
the last,
That's
I
so-
know, right? I feel like they should teach that in school more.
they don't do anyways. Yep.
Is anything practical anymore? It's like Pythagorean theorem. Sorry if anybody actually uses that.
I don't think actually I can't say, but I really wish they taught more of this stuff in school.
But I said there was four things. The last one is credit inquiries. So this is also a common one. I'm sure you get it too. Do you ever have a client that's like, oh, I don't want my credit pulled? Because they think that's going to impact their score, which it does. Say if I pull something,
If
what's
you
that?
I okay, one thing I've heard is that anytime you log on to your banking app or whatever, you check your credit score, it goes down a point.
So that would be called like a soft pull. I'm sure it impacts your score in a way, but I'm talking about like hard credit bureau inquiries. So
Okay.
that would be say you're going to get a car or take out a new credit card, take out a loan or apply for a mortgage. So somebody like me pulling your credit bureau, which would be like a hard pull and a check of your credit. So that does impact your score slightly. But a lot of people think it's going to have some like, hey, I was this close to qualifying, you pulled my you pulled my credit, and like, if you're going all around town and pulling your credit constantly, yes, there will be an impact to your score.
Yeah.
But say you talk to me, you talk to TD, you talk to multiple people within the mortgage space. It actually only counts as one pull if it's within 45 days. But don't do that because I'm going to shop for you. But the actual impact that it has is about 10 points. And you would actually be getting those points back within 60 to 90 days. The reason that this system is in place, it's actually to protect your identity, which I thought was like a movie plot when I first heard. I was like, what do you mean? But lenders and the government actually assume that, say, if somebody was like to steal your identity, the first thing that they would do is try to take out multiple loans.
You know
And
what
so
happened to Mike, right?
they have an alcohol.
Yeah, sorry, yeah, Mike, his identity was stolen.
Oh my God. Why didn't they choose somebody else? Somebody like way cooler. I wouldn't have gone for him of all people. um,
Sorry.
that's just okay. There you go, right there. And he probably got notified by somebody that, hey, like
Yeah.
people are trying to put loans out under your name. And one of the ways that they can flag this is they see that every time a loan is applied for, your score gets impacted. And once it's pulled a certain amount, it's going to notify the system that, hey, there's some like irregular activity here. But
Oh,
again, the points aren't gone forever. But that is why the system's in place. So the next time you're thinking like, oh, like I don't want my score to be permanently damaged by this, It's not permanent. Again, unless you are actually pulling those hard bureaus over and over and over again, which nowadays we have all those like credit apps that you can use. I know I get like Borrow Well and all these notifications.
Yeah.
Those are kind of accurate. They're not entirely accurate though, but it does give you kind of a baseline and it will not impact your score. As far as getting approved with a bank, here where I said it's like pass fail 650 and above, that will allow you to work pretty much with anybody in the A space. A lot of people also ask me like, oh, how do I get my score perfect? And I've worked with Johnson on like thousands of applications at this point, and I've only seen it twice.
I was gonna say I've seen it, I think once or twice where like
Already? Heck yeah. There we
yeah,
go. Actually, we saw one the other day too, and we were like, oh my God, like this
yeah,
is
like
so
you remember it because you're like, did it? I'm like, good job.
yeah. But it's usually like, say, like 60-year-old doctors who've had like credit for long periods of time, who have perfect repayment history, have had like the mortgages, have the cars. So especially people in our age group and like first-time homebuyers, you're not going to see it that often, especially because if there's some like blip on the radar, or like you missed one cell phone payment. If we've only had credit for like 10 years versus someone who's had it for 50, that little blip's going to impact us way more than it would somebody that has had that long standing credit history, right? So that's why you tend to not see it all that often. And even if you do have a 900 credit score, that's absolutely amazing. A lot of people, like, especially in couples, they like to compete with one another. But it doesn't necessarily mean that you're going to be getting a better rate or anything like that.
Okay, so question. Say I had like 800 credit score and my partner had below 650. How would
So,
how would you go about that?
because remember when I was saying like the lenders are going to look at two main things: it's going to be your credit and it's going to be your debt to income.
Yeah.
Depending on like how bad that score actually is, it could really impact that file to the point that you might not qualify. So generally in a situation like that, we would kind of weigh our options there. Sometimes we would have to go into the B space because you
Okay.
can't just have one person that's perfect and one person that's got like a 500 credit score. I would oftentimes recommend removing that person from the application and running it without them, just because if those two components, if one of them is impacted that highly, like they're not going to qualify in the space that you'd like. If you still need their income to qualify, then I would suggest something like a co-signer in order to compensate for that income. But generally, if it's a very bad score, having them on title would do more harm than good, if that makes sense.
Interesting. So, okay, if there was a couple that wanted to get a house together and one has amazing credit, one has trash credit, what do you think the best way for them to go about that is? Like,
Wouldn't it be great if you could just like meet in the middle and be like, this one's perfect, this one's bad, let's combine them.
yeah. Yeah, now I'm like working out situations in my head with like
you're like, should I dump my boyfriend? No, I'm kidding. I'm sure Kyle has great credit, but so in that situation, I am the one with bad credit. So I'd really want to assess that credit bureau and see obviously why the score is the way that it is. You oftentimes find when it's like that bad, there's tons of missed payments. There might be a consumer proposal or a bankruptcy or something on file. But generally, I'd want to go out on a path with that person to help them repair their credit, give them some easy tips, see if there's anything that's reporting that's like abnormal that shouldn't be there. So that would be my baseline of where I would start.
Okay.
But generally, if your credit score is that damaged or bruised, you may not be the best candidate to be on title of that home. Right. So I would generally, after going over our options, seeing like a timeline in which we could repair that credit, I would oftentimes run the application without that person.
Okay.
If it's slightly bruised, we might be able to go into the B space lending. But outside of that, we can do a private. But again, you have to weigh your options, whether you want to pay that premium to keep them on title or whether you want to remove them and exercise other options if you need their income, like I said, like a co-signer or something like that. I've had like lots of first-time home buyers that come to me and they've had like some blip, especially if like you're younger. As I kind of mentioned before, if you make any mistakes when you haven't had credit for that long, it impacts you way more heavily than if you've had it for decades and decades.
Right.
Right. Looking at your timeline, if there's one blip on a short timeline, way bigger than if it's a long timeline. But so often I see people that have like switched cell phone providers, and their score has been slightly impacted because of that, because they've forgotten a cable box or something small. Like, oftentimes we can create a story to try to get that removed. It's not like completely unfixable, but sometimes it's just time and better habits. But teaching those things early is actually super important. Also, like taking on debt, like car loans. I get so many people that come to me and they've got like this sick car that costs like $1,000 a month. Relative to their income, though, it is a huge expense to take on, and it really impacts their ability to qualify.
Yeah. I feel like this needs to be known. Like,